Hello and welcome everyone to episode 16 of the IFAD Innovation Talks. Before we start, I would like to remind you that today's event is being recorded and that by joining the event, you are agreeing to the recording taking place and for it to be shared in our social media platforms. As usual, I would like to invite you to visit our event page to check the speaker profiles, the event's concept note, and the agenda. Julia is sharing with you the link in the chat box. If you're new to the IFAD Innovation Talks, these are a series of learning and knowledge sharing sessions lasting an hour, where we aim to feature innovative approaches, tools, products, and services developed by IFAD, our partners, and the members of the IFAD Innovation Network. If you're not a member of the IFAD Innovation Network yet and would like to become a member, please apply in the link provided in the chat box. The chat box will be open at the beginning and at the end of today's event, so please make a responsible use of the chat box, but by not advertising commercial products. Thank you. Today, our speakers will be engaging in an in-depth exploration of the transformative role of sustainable finance in addressing global climate challenges and social upheavals. Our speakers will also highlight the critical importance of environmental, social, and governance issues to international collaboration between public and private sectors. You will hear from our speakers about how multi-trillion-dollar investments are still needed to achieve ESG goals, and about the innovative financial strategies we are implementing to deliver these goals. So please feel free to post your questions in the Q&A function on Zoom, as we will be collecting questions from there, basing also on your app voting the questions. So I will be prioritizing those questions that have the most votes. So feel free to post and also to vote so that we know which questions you would like to have answered first. Without much further ado, I am honored to introduce IFAD's Director and Treasurer, Gulnara Yunusova. In this position, Gulnara is responsible for IFAD's borrowing program, liquidity management, financial planning, balance sheet management, and back office operations. Before joining the IFAD in 2021, Gulnara spent almost 2 decades at the World Bank Group, starting her career on the ALM desk at IBRD and then transitioning to IFC Treasury, where she oversaw the delivery of derivatives and local currency solutions for IFC clients. Gulnara holds a Bachelor of Science in Economics from Uzbekistan University of World Economy and Diplomacy, and a Master of Science in International Finance from the School of Foreign Service at Georgetown University. I just actually came to learn while preparing for this event that Gulnara and I share the same alma maters, as we both went to Georgetown University, though I was there for my Bachelor of Science. So I'm very honored to welcome a fellow Hoya to the floor. And dear Gulnara, the floor is yours.
Thank you very much, Gladys. Good afternoon, good evening, good morning, everyone, and welcome to the IFAD Innovation Talk. As I learned from my dear friend Gladys, there are 3 key ingredients to effective innovation. Innovation needs a moonshot, innovation needs discipline, and innovation needs resources. So the asset managers representing on the panel today definitely have resources. They definitely have discipline. What about the moonshot? Do we really need to get to the point where SDGs risk overrunning into a real terrain? It's a diverse panel, but the common denominator is clearly SDGs, delivered through the mechanisms that are unique to the institutions represented on this panel. And while the delivery mechanisms vary, the core mandate remains the same, making speedy and sustainable progress towards achieving SDGs. And the amount of money represented in this room is staggering. IFAD manages roughly $2.5 billion of its own and trust fund liquidity. NIB manages about $15 billion, give or take. ESM manages about $80 billion of paid-in capital managed through the treasury investments. World Bank manages north of $200 billion across different mandates, including pension fund and assets through RAM program. In fact, RAM clients collectively manage close to $2 trillion. Why do these numbers matter? Well, they matter not only because of the size, but also for the purpose with which they're managed. So we're here today. We have a fiduciary responsibility to our shareholders, to our partners, to those who fund our trust funds, and to the retirees who count on the pension assets. And that fiduciary responsibility really boils down to 3 things: capital preservation, liquidity, and returns. So given these investment mandates, how do we direct these investments to support SDGs when most SDGs, one could argue, do not generate sufficient cash flows, can put capital at risk, and may not be the most liquid of assets? So what is that pathway between the liquidity that is managed, not only in this room, but globally, to deliver financing SDGs at scale? To bring it back to innovation, IFAD is unique when it comes down to SDGs. We actually walk the talk across the entire balance sheet. Firstly, on our funding side, we're the only specialized agency of the United Nations to tap into the power of capital markets and to mobilize funds through the issuance of bonds under our Sustainable Development Finance Framework. And the framework shows clearly how the proceeds from IFAD's bonds are used to finance our loan portfolio. Secondly, our mission portfolio side, through our projects, we support 16 out of 17 SDGs, with the only exception being SDG 11 on sustainable cities, understandably given our mandate to operate in rural areas. And lastly, in our alliance with peers across the UN, MDBs, and other IFIs, we've made steady progress in incorporating SDG considerations in managing treasury investments. To close off, I want to ask two questions. What would it take all of us here today to scale up investments in SDGs? And also, who is missing in this room? What about regulators? What about rating agencies? What about those who determine how risky these assets are? What would it take them to recognize that investment in resilience is good for credit? What would it take them to recognize that investment in resilience paves the way for a more sustainable environment for future investments? So I have high hopes for this panel. And I hope we'll come out of it convinced that profitability and resilience can go hand in hand. Thank you.
Thank you so much, Gulnara. And thank you so much for making the time also to join us today, because we know that you're very, very busy. Gulnara is currently not only heading Treasury, but she's also heading our communications department. Gulnara has mentioned some points that I think are very relevant, moving on to our panel, and they have to do with IFAD's strategic position as both a UN agency and an international financial institution with access to capital markets. But I think that one of the most relevant things that you mentioned also today is how IFAD is tracking performance and providing our investors also with reports on the impact of our investments. So thank you so much, Gulnara, for that contribution. And moving on now to our panel, please join me welcoming our lead technical officer and the designer of today's Innovation Talk, Sheila Kodamos-Platel, Head of Investments in IFAD's Treasury Division, Anna Hirske, Senior Financial Officer, Asset Management and Advisory Department, Reserve Advisory and Management Partnership at the World Bank, Sebastian Levy, Head of Investment and Treasury at the European Stability Mechanism, and Zach Druve, Head of Portfolio Management at the Nordic Investment Bank. I would like to ask everybody that is online to please turn on their camera so that we can go into gallery view. And with that, I'm going to give the floor to Sheila. Sheila, over to you.
Thank you very much, Gladys. Thank you very much for the very generous introduction. It's wonderful to be here with all of you. And I would also like to express my appreciation to our keynote speaker for such an incredibly eloquent message to start it all for us. So good morning, good afternoon, and good evening to everyone, wherever you may be joining us from. Welcome to this hybrid panel discussion. It's a privilege to be able to moderate a panel on a topic that is very close to my heart. And I would encourage you today, whether you're in the room or online, to please do prepare your questions to the panelists. We're aiming to have time towards the end of the session for some of your questions. It's an honor to have our panelists here with us today. We thank them for their willingness to engage with us on this hotly debated and highly complex issue of ESG. I'm hoping that this opportunity for dialogue will help all of us to cut through the noise and focus on what is important to determine whether or not profit can go hand in hand with purpose for responsible investors in bond markets. So by the end of this discussion, we aim to provide more clarity on whether or not a responsible investor having to choose between doing good or making good returns is a tired fallacy that we need to ditch when it comes to investing in financial instruments such as bonds based on values rather than exclusively based on economic value. So before I start with our panel discussion, though, I do want to make a disclaimer that the remarks coming from this panel will be based on our personal position and based on what we have been working on professionally, and not necessarily the official position of our respective organizations. So now with that out of the way, why don't we go ahead and start? We have a number of interesting topics to cover, so let me now set the scene for the purpose of the discussion. So all four of us in this panel, as you've heard, is each responsible for billions of assets in dollars and euros under our management, which are comprised effectively by money from taxpayers all over the world that makes the way to us as official institutions through contributions from our member states. So in order for our institutions to fulfill our respective mandates, which directly or indirectly are supportive of the United Nations Sustainable Development Goals, our job is to build resilience on our investment portfolios to a range of possible outcomes. So on one hand, incorporating ESG considerations in investment management is fraught with challenges, but on the other hand, the entire financial ecosystem has been working together to harness the power of markets to contribute to the solution. So financial markets have actually gained traction in mainstreaming ESG considerations in investment management since the 2015 landmark International Paris Agreement on Climate Change, in which 195 signatory countries of the United Nations Framework Convention on Climate Change laid the groundwork for the 2020s decade of action for the delivery of global goals. So the Sustainable Development Goals, consisting of 17 SDGs, which served as a call for action by all countries to promote prosperity while tackling climate change and environmental protection, were adopted in 2015 and provided further impetus to the campaign that aims to firmly entrench sustainability into the financial and economic system. But let's start unpacking the most controversial part for responsible investors. So the potential trade-off between financial returns and ESG quality of investments, as well as the perceived breach of fiduciary duty in ESG investing, remain widely debated and weighed down by mixed results in the existing literature, varying across geographies and economic cycles among a multitude of factors. So there's been heightened focus on greenium in past years, for example, that responsible investors pay a premium for bond investments in issuers with clear ESG trajectory, given their deemed low-risk profile. So the tone and thinking of this investment philosophy is that looking beyond the P&L and the balance sheet into stewardship of the environment, the E part of ESG, and of people, the S, the social component of ESG, and of good governance, the G, is supportive of profitability, supportive of financial stability, and so on the whole are all essential elements of the risk management toolkit for responsible investors. So the question I have for the panel is on how we are seeing this difference in terms of risk and performance between ESG bonds and conventional bonds so far. So let me direct my first question to Anna. The World Bank has proven itself to be a trailblazer in bringing innovative financial instruments to the capital markets as an issuer of ESG bonds, such as green bonds, social bonds, sustainable bonds, sustainability-linked bonds, among others. So green bonds finance or refinance environmentally sustainable projects, such as those for the mitigation and adaptation of climate change, conservation of natural resources and biodiversity, and the prevention and control of pollution. Anna, do you find that the inclusion of ESG factors in the investment portfolio construction process for fixed income asset classes come at the cost of weaker risk-adjusted returns? What is your current thinking on this? And over to you, Anna.
Thank you very much, Sheila, and very happy to be here today to discuss these important topics. So when it comes to the difference between risk and performance of these securities, in theory, they should be the same as the bond issuing entity is the same. And I could take sort of like a case of an entity issuing a conventional bond and an entity issuing a green bond, for example. The risk to the investor is still the same entity that is issuing the bond. Hence, in theory, the risk and performance should be better, should be the same. But then in practice, we see that the labeled bonds, especially the green bonds, tend to have a big demand versus supply, leading to scarcity. And so we may see that the green bonds do trade with a small premium over the conventional bonds, and this is also known as greenium. On the other hand, due to this excess demand, the green bonds are very liquid, as there is that demand in the secondary markets. So if you do want to sell that bond, you're very likely to be able to sell it at a very, very good price in the market. Another point I would like to make on this topic is that some studies have shown that green bonds hold value better than conventional bonds. But this comment is definitely not to be taken as investment advice. So not that you go and start rushing to buy green bonds just because we've just mentioned something along the lines of the returns here. Just because something is green is not an automated reason to start buying it into your portfolio. All investment decisions should be carefully considered against the investment policy, investment strategy, and that includes sustainable investment products. I'd like to stop my first comments here and give room for my fellow panelists, and hopefully we'll get a good discussion going.
So thank you, Anna. Thank you for giving us some color on how the observed risk and performance characteristics of ESG assets closely resemble those of non-ESG assets. So let me pose the same question to Sebastian. Sebastian supervises the investment of ESM, and which was really created to provide support to Euro area countries experiencing or threatened by severe financing problems. So Sebastian, could you give us your perspective on the observed risk-adjusted performance of ESG bonds versus non-ESG bonds? You have the floor, Sebastian.
Thank you, Sheila, and thank you very much for the invitation. Very, very pleased to be here. I think Anna made a very good introduction on regarding those ESG bonds. So I will not go back to the specificities. In practice, ESM, for instance, we've been investing in those assets since 2014, and our share of those of our holding has been growing. Currently, we have 4 to 6 billion in the portfolio. It depends a little bit when we look at it. So we do monitor how those bonds are trading compared to the bond issued by the same issuer, but which do not have a label like green, social, or sustainable. Things have changed a little bit. At the beginning, I think a few years back, there was a premium. Those bonds were probably less included in asset manager strategies. So they tended to have a good premium at the start and then to perform. Recently, things have changed. And when we look at and analyze the premium, we don't see that much of a premium. Sometimes it's a few basis points higher, sometimes it's a few basis points lower. But we see this with all the type of bonds. It's the fixed income market is not perfectly priced at any point in time. So it's today I would say that we don't really see that trade-off. One thing to mention is that the calculation of the greenium is not necessarily easy. It's not theoretically complicated to calculate it, but you don't have necessarily the right reference to compare the two securities to really say this part is the greenium. So you tend to have liquidity differences. This is not a market which is as deep, so greeniums don't have the same market depth. You have also some curve issues. when you have the curve is not really smooth, you tend to have, but this is more for technicians, your model or interpolation might be wrong by a few basis points. So you don't necessarily know which part is green, which part is just a model estimate error. So in practice, just to sum up, I would say we don't see much of a difference. We monitor it because as for every other assets, we want to make sure we don't keep assets that would be mispriced. But yeah, we don't really see that trade-offs. Thank you.
Thank you, Sebastian. So indeed, that supports what Anne has spoken of earlier as well. But on the difficulty in estimating the greenium, that's another widely documented phenomenon in markets, right? And the distinction between primary and secondary markets complicates it even more. So now let's go to you, Zach, at NIB. You have a liquidity buffer of approximately 16 billion euros, of which around 10 billion euros is in your long-term bond portfolio and a further 6 billion in the short end. So do you share the view that we've heard so far? Over to you, Zach.
All right. Well, first off, thank you so much for having me on the panel, to obviously Sheila and IFAD. And obviously a big hello from NIB's offices in Helsinki. So look, I largely agree with what the other panelists have said in terms of the risk and return profile of conventional bonds versus ESG label bonds. They're very, very similar. So I think the differences are really at the margins. One thing that hasn't been mentioned yet is in terms of the risk profile. In periods of market stress or instability, I think it's fair to say that ESG label bonds hold their value a little bit better than conventional bonds. And that's largely a result of the investor base. That they tend to be a little bit more long-term, a little bit more buy and hold. And also good to remember that a lot of investors, ourselves included, have sustainable bond holding targets, i.e. if they have a liquidity event or a need to raise liquidity, the first thing they're likely to sell is going to be conventional bonds, not ESG label bonds. And so for that reason, I think they have a habit of holding their value a little bit better than conventional bonds. Also from an issuer point of view, I think ESG label bonds also adds an element of diversification in the investor base and might help them smoothen a transaction in tough market conditions as well. In terms of the greenium that was mentioned, I agree with Sebastian. It's very difficult to pin down. It largely becomes a bit of a theoretical exercise because there's a lot of other factors at play. I think where it's perhaps less theoretical and much more practical and easier to measure is, for example, in the case of Germany, where they have a twin bond, where they have one conventional bond and one green bond, which they issue at exactly the same time, that have the exact same maturity and the same coupon. And then it becomes a little bit easier to say, okay, what is the actual greenium being paid? And I think typically recently that's been between 1 to 2 basis points. But even in that case, there are differences, for example, in the issuance size of the green bond versus the conventional bond. So to Sebastian's earlier point, some of that greenium could also be this liquidity effect as well. Then just perhaps switching to the return side of things, since it hasn't been mentioned yet, there's also sustainability-linked bonds that offer investors, the potential to have a step-up coupon if certain ESG-related KPIs are not met by the issuer. I think the caveat there is that the step-up tends to be quite small and perhaps not very material in the context of overall financial performance of that particular bond. But I think it does, pose an interesting dilemma to investors because this is a case where the return is actually inversely correlated to the ESG performance of the issuer. So, yeah, those are a couple of the differences. But I think largely I agree with the panel that there's more similarities than differences between ESG bonds and conventional bonds.
Zach, thank you. So there is a sense across the panel that ESG is neutral to investment performance, despite the slight premium due to the scarcity of ESG bonds relative to the supply. Let's pivot ever so slightly to sustainable finance-related bond investment strategies. Here we can pursue negative screening, ESG integration, positive screening, and investing in ICMA-labeled ESG bonds. This one's over to you, Zach. Could you give us some insights on the pros and cons of negative screening that is aimed at avoiding the worst ESG performers? How does it compare with other methods, such as ESG integration and positive screening that are designed to steer bond investments towards the best ESG performers? Zach?
Yeah, so at NIB, we have three main elements of our ESG investing approach. The first one, as you mentioned, is an exclusionary list or negative screening. The second is this best-in-class approach where we try to tilt the portfolio to better rated ESG issuers. And then the third is a target for our sustainable bond holdings. So on the first one, in terms of pros of an exclusionary list, the obvious one is that it's relatively simple to implement, but I would say hard to agree upon. So what do I mean by that? I mean, in terms of once you've agreed on the sectors, on the industries that you will not invest in, then it's relatively simple to implement. It's quite easy not to invest in those counterparts, and it doesn't require that much follow-up. Of course, it requires monitoring of the counterparties, but that you're doing anyway. I think the con, as I mentioned, it's hard to agree upon. So some things on the exclusionary list is relatively easy and straightforward. So some things like counterparties that engage in forced labor or child labor, that's quite easy to put on an exclusionary list. But then there are shades of gray where there's not necessarily a consensus. One example is the defense industry. So before the war in Ukraine, the defense industry was on most people's exclusionary list. And since then, society or social norms have changed, and there's been a lot of change on that as well. For example, there's discussion on whether there should be an extra S in ESG, the S standing for security. And the argument goes something like, how can you focus on environmental, social, and governance if you're not secure? And then there's other industries like nuclear power as well that is sometimes controversial to agree upon. So that I would say is the con. In terms of the other approaches, I think the best-in-class approach where you're tilting to certain ESG or issuers with better ESG scores, I think the pro there is it adds an issuer sort of dimension into your overall approach. So many have a product level approach where they set a target of I want to hold X amount of sustainable bonds, but a best-in-class approach also allows you to have that issuer view as well. I think the con on that one or the difficulty there is one, data coverage. Not all issuers actually have an ESG rating. But for me, the more substantial con is that there is a lot of divergence across ESG rating providers. So from my vantage point, I see quite a low correlation across scores. And I think that poses a bit of a challenge for investors, particularly if you're running quite a large portfolio with a lot of different issuers. It becomes a bit burdensome, therefore, just to go through each of the issuers and understand what are the differences across those ESG rating providers. There is huge differences in methodologies. For example, when it comes to weighting governance, some rating providers give a minimum score, some don't, or a minimum weighting, I should say. So there's large differences, and that I think in general poses a challenge for investors. I would say there is an interesting parallel with credit ratings. So in the past, if you think back a long time ago, 30 years ago, there was more divergence there. And I think there's perhaps an interesting parallel whether we'd start to see more convergence with ESG ratings as methodologies get a lot more robust and best practice gets more established. But I think that there's the other side that thinks ESG ratings are a lot more inherently subjective. So whether we get there in the end, I don't know, but would be interested to hear others' views on that as well.
Indeed. Thank you, Zach. So I hear you on your remarks about negative screening and best in class. Let me turn to you, Anna. How are you weighing the balance of risks and returns on current ESG investment strategies? Floor is yours, Anna.
Thank you. Before I go to the pros and cons, I actually would like to touch upon a little bit what Zach just mentioned about the ESG scores and the ratings. And I love whenever there's a panel where people don't agree on every single point, and this is one of those points. I absolutely love that the ESG scores by different data providers do not correlate. And whenever there's that discussion that they need to correlate or they should correlate because credit ratings correlate, my sort of go-to question is, do we know what question the ESG rating or the ESG score data providers are trying to answer? It's not the same question. Whereas with the credit rating agencies, it's one single question that they all try to answer with it, which is what is the probability that the issuer is able to service its debt. Whereas ESG, it's much more complicated. ESG is not one thing. It's not even three things. There's no one environmental issue, not one social aspect, not one governance issue. So you will have different weights, different methodologies on how to get the data. Where I do agree where the data should correlate is when it comes to, for example, some carbon accounting. In those cases where we're talking about hard numbers that we should be getting from reports, and they should be fairly standardized. Those are the ones where I would like to see more correlation going forward. But on the overall thing, I think it's great that we have different methodologies and different data providers, because that means that every single investor, because we all have our unique investment strategies, our investment policies, it means that every single investor should, in theory, be able to find a data provider that sort of like suits their worldview, because like Zach said, some of the ESG issues are sort of like subjective, and hence there needs to be that understanding of the methodology. There needs to be that resource from the investor side on understanding what is the data that we're buying and where we're using it, what is the question that the data provider is trying to answer, and does that question actually correlate with the questions that we are trying to solve within our investments. So it is super important that we need to understand the processes behind the scoring methodologies, and we need to look beyond the score or the rating, because the score itself doesn't tell us a lot. We need to know more about the story behind them, and it's interesting to see that some of the data providers nowadays, they actually don't sell the score. You can get the scores for free on Bloomberg Terminal, for example, because that is not the product that they are selling anymore. It is the underlying data, the raw data. It is the analysis behind the score itself, and not the actual score. Going back to the pros and cons of these different sustainability strategies, I hate to be a bit of a sort of like politician, like stereotypical politician, by answering a question through not answering a question. But the answer is that these strategies need to be considered based on the overall investment policy, the investment strategy, on the investment objectives, on the time horizon, on the ability and capacity to take on risk, on the asset classes available, etc. So negative screening, great tool for aligning your your sort of corporate values with your investments, for example. It can be a good tool to mitigate reputational risk, headline risk, and so forth. But if you are an investor who wants to create impact with negative screening, you're quite limited. And in that case, you'd probably want to use a strategy like engagement more than just the negative screening to get more of that impact. But any of these strategies, they do require resources. So one sustainable investment approach is not automatically better than the other. It just all depends on the investment strategy and the asset classes. Just a general remark, though, saying that using sustainability data is useful to identify risk and opportunities. And you may want to try to to produce outperformance through risk mitigation or excess returns from large macro themes like climate change. But again, use of data requires the resources for the reasons I just mentioned earlier. So that would be my remark. Thank you.
Thank you, Anna. Thank you for framing it in that fashion. I do agree with you, and the ESG approach selected by investors is determined largely on the basis of preferences formed by their investment management philosophy. And of course, institutional values, as well as the eligible investment universe within their fiduciary responsibility. Now, I'd like Sebastian to come in on ESM's ESG investment strategy of choice. Over to you, Sebastian.
Thank you. It's a very interesting question. So I think on the ESM side, we are using, and as Zach mentioned, I think they're also using a range of strategy. Very few institutions, as far as I understand, only have one approach. In the case of ESM, we have decided to invest in ESG level bonds. That's what we discussed a little bit before. We applied some negative screening, but very lightly on some issues that we think are where there's a broad agreement also, as Zach mentioned. And in our case, sanctions is a very clear red line. And we apply ESG scoring, and then I will go back to the points that Hannah already discussed. Looking at the ESG level bond approach and investment, I think it's many institutions have done this. It's quite easy. You don't really change anything. You don't change the issuers you're investing in. You just invest in bonds that have a dedicated use of proceeds. So I think this contributes very well to what we're trying to do, which is to provide financing to special green objectives or social. The problem with this approach, and the reason why it cannot be used alone, is because there is not enough of those bonds in the market. The share has increased a lot. It used to be, when we look at the ESM investment universe, it used to be about 2% of our investment universe. Now it's closer to 4 to 5. But for 80 billion portfolio, you cannot base your whole strategy on 4 or 5%. It's mainly euro area issuers, agencies, supranationals, and the longer part of the curve, which is where there's the most issuance. So they are part of the strategy, but they only, you can only do so much with those bonds. On the negative screening, it's also, as Zach said, I think we agree here, a very easy way, a very easy solution. But because for a new investor in that field, you have your investment universe and you just say, okay, I will take out some names. So you can very easily do something and manage reputational or legal risk, which can be attached to certain activities like child labor, as Zach mentioned, for instance, or defense. But if you only use this approach, you might say you're not doing enough because you don't change the rest of your activity. So we think, in our case, we've decided to focus on the scoring of our paid-in capital using ESG data provider. We think it's extremely helpful because you can cover the entire investment universe. There are some coverage issues, but overall, agency do a good job at covering a broad-based investor. The issues that were mentioned by Zach and Hannah are clearly there. And this is why it takes time to define which is the one that you want to use, which data provider provide good information to score your activities and is in line with your requirements. So in one difference that I want to mention, because it's important, is the philosophical difference between people who want to focus more on the risk mitigation and others who want to focus more on the impact. So some ESG data provider will have a different mix of those two directions. Some will clearly focus on risk, climate risk, for instance, ESG risk. Others will focus more on the impact. So what is this? It's not asking, the question which is asked is not, is my investment risky because of the climate, but is my investment contributing positively or negatively to the climate, to put it in a simple way. So those things need to be discussed. And in the technical aspect, I think some improvement could be done, because the type of indicators used, how those indicators are aggregated, the statistical methodologies, they can be very different across agencies, and even the rating score, the philosophy behind it can be extremely different, with some institution focus having a sort of a bell curve approach across the scoring, some other having a more linear. So you will get very different messages depending on which data provider you use, and this is I guess the challenge of this approach. But it has we found it very useful to cover the entire portfolio of large public institution, because it's a very efficient way to balance your credit worthiness, liquidity, return aspect with the question of sustainability. And I will stop here. Thank you.
Thank you, Sebastian. You made some extremely important points there, and should give us pause for thought. I am told that we're running out of time, but I'm aware that Zach would like to come in on this question. So just a quick response, perhaps, Zach, please.
Yeah, no, just really quickly. I too like when we don't always agree on the different points. And to the question about ESG ratings and their divergence, just a couple of points from my side. So one is, I think Sebastian mentioned this as well, is coverage is not perfect, right, across issuers. So then sort of automatically you're in the world of perhaps looking at two different types of ESG rating data providers. And then therefore you have a challenge when it comes to methodologies differing, if you want to get that higher percentage of coverage, at least for us. And then, when it's not standardized or more sort of aligned in terms of methodologies, you're in the world of then spending a lot of time and resources, combing through the different ratings. And when you have so many different issuers, when you have more than 100 different issuers, it becomes a challenge to do that. And then the last point I would make is that, when it comes to things like governance, to me, it's not clear to me that should differ so much in terms of methodologies on how we assess that. I think good governance should be largely the same, regardless of what industry you're in. Good governance largely looks the same, that you have an independent board, for example, and all the features of good governance, that they're able to effectively challenge management, etc. So to me, it's not clear why methodology should differ so much in assessing that. Would be the point that I'd like to make. Thanks.
No, thank you, Zach. Here again, the harmonization of ESG approaches seems far away and uncertain, given differences in ESG philosophies. Institutions will likely need to define their own priorities to be able to identify ESG information providers that are more in line with their approach and ESG framework and with their mandate. But let's wrap it up there. There's a lot to think about from all the comments made in this panel. So connecting the dots on everything we've heard so far, having considered the arguments for and against various aspects of ESG bond investments, the main takeaway I would see from all these trends is that we are making meaningful progress. There's the mainstreaming of responsible investments in capital markets is really underway. And the ESG movement has enriched the diversity of bond instruments for responsible investors. And the diminishing green bond premium that we see is a very good sign of sustainable moderation in this market. That said, the other thing that comes out of this panel is we have some homework to do. The path to sustainability is never going to be easy, but it can and must be done. And in order to achieve this, we need innovation and collaboration across disciplines. I am of the view that all these birth pains we spoke about today are understandable, given the nascent stage of the ESG market. Echoing the points made across the panel today, yes, there are broader issues to be tackled, but it is very high on the agenda. It is clear that things will have to change. Sustainability data must be treated with the same rigor as financial data. Systems and processes will need to be enhanced, governance structures changed, awareness raised, and the potential business benefits identified and captured. We have this massive opportunity to fix the financial ecosystem. And the tone of governments and regulators, central banks, and financial market participants is a healthy development. So let's all take a step back from the noise and look at the data. Let's be analytical and clinical about it. Generally, the direction of travel is positive. So even if at first glance it seems to be about reporting and compliance, the real goal is to create a culture shift to integrate sustainability into the way companies are run. And this is where it becomes more meaningful. So we're making strides in responsible investing. And it is a testament to the power of working together. So we need to stand by our unwavering commitment to keep pushing boundaries, testing the cognitive limits of innovation, collaborating across financial markets. So I warmly invite everyone to get involved. And with that, Gladys, back to you.
Sheila, thank you so much. And thank you to all the speakers for a very engaging panel. I would like to go back to IFAD's mandate and our laser focus on those most vulnerable groups and small-scale farmers. And the reason I would like to go back to that is mainly because of the very interesting discussion and around the theme of harmonization and the standardization of the ESG scoring. I am recognizing and acknowledging Anne's contributions and also Zach's position on good governance should always, should be harmonized and a standard for almost everywhere. But we also have to recognize that we work in very diverse environments and with very, very different also cultural backgrounds and contexts. Some of the populations that, we work with indigenous populations, and sometimes traditional knowledge can be a source of innovation. Data is the data that we have access to cannot always take into consideration all those human factors that have to do with environmental sustainability and with traditional agricultural practices. So let's open the floor because we have a lot of questions coming from the audience. I'm going to also to give an opportunity. Thank you so much for everyone joining us here in the room in person, but I would like to give the opportunity now to the audience. We have a question regarding the technologies that your agencies are using to complement the methodology so that you can screen and discern among ESG compliant companies. Can you share with us what kind of technologies are you using to support the methodologies that, for that, to discern between ESG compliant companies and those that are not? Thank you. Who wants to take the question?
So I'll take that question first, and then I'll pass it on to the other colleagues, perhaps Zach after you. In IFAD at least, right? So, and across official institutions, it's quite common for all of us to use treasury management systems and compliance systems that are also connected and fed with ESG credit rating, for example, the sustainability data that we check against. So that's my quick answer to that, and I'll pass it on to Zach. Thank you.
Yeah, for us, from a technology point of view, it's relatively simple because we depend on external ESG rating providers. In our case, it's ISS and MSCI, and we take in their ratings on a frequent basis. We also use ISS for norms-based scores, so to monitor controversies and the like. And that's continuous as well. So we bring in that data into our systems on a regular basis, and that is external data from external providers.
Anyone else?
Oops. Sorry.
Sebastian, go ahead. I'll follow you.
Yeah, there's very little to add actually, but we use also an external data provider. We picked a different one, so that we picked Moody's VGO, which focus more on the impact, and that's what we were trying to achieve at the ESM. And in terms of technology, yes, we download the information on a monthly basis, and we have our own internal Python tools to match it with our portfolio. So not a very complex technical solution on our side. Thank you.
I'll just give a more like general view on sort of like systems that I've seen throughout my career. Some investors used for example the data from third parties, for example on pre-trade compliance checks, so that then your trading system wouldn't even allow you to trade on a particular name, for example. And the ways to do it, there are multiple different ways. You could use the data on your risk management tool, maybe to put your trading limit to 0, which obviously then would highlight the case that you can't trade the paper. AI is something big in the financial markets happening, and also if we look at the EU legislation coming up, is that the new reports, they need to be machine readable, and that is exactly the reason why they need to be machine readable, is that then we can dissect through tons of data automatically, and then the human touch is for the more detailed and sort of like making that subjective or sort of like based on your own expertise type of assessments, but you get the raw data already in a meal piece sized bites for you to consume.
Thank you so much, Anne. And that poses a challenge in itself, because making all this data and the reports also from different sources, and we're talking here about countries that have different capacities and capabilities, and to be able to have all the data that is machine readable, so that you can leverage on, for example, artificial intelligence to be able to make sense of all the information that you have. That poses a challenge in itself. There is a human aspect. We call this innovation talk with I think somehow a compelling title, trying to address both profit and impact. So we have a question from the audience, and the question has to do more with the human aspect of the impact investments. And how do you persuade investors that could be potentially turned off by the idea that responsible investment can be profitable too? How do you somehow marriage these two concepts of profitability and impact investing? Who wants to answer that? And we don't have much time, but we have 2 minutes, so I'm going to ask you to be succinct, please.
Sebastian, I think you'd like to comment on this, so please do go ahead.
Not particularly, but if you ask me, I will try. It's difficult, ESG became a political topic. People have different take on what should be done. I would say that even without going into this broader discussion, even within an institutions, people can have different level of sensitivity to different topics. So where to put the line between what is acceptable, what is not, is not easy. And as Zach said, you may have a lot of discussion on this topic. In the case of ESM, and I think in the case of institutions, I think it's good to go to the core of the institution mission, the core of what are the principles that are widely accepted, democratically accepted, so that you establish them as the basis for those decisions. In the case of ESM, which is part of the European institutions, when we hesitate on how far we should go, we look at what are some of those document texts that has been approved by the EU, for instance. But on the much broader discussion. It is good in a way that there is a debate. I think this debate will continue, and I think we should embrace it with the arguments that we have, and hope to reach some kind of consensual middle point. And I will stop here. Thank you.
Thank you, Sebastian. I'm going to have
say two phrases.
very, very quickly, please.
Yeah. So I think we might want to go back to the notion of people, planet, and profit, whichever order you wanna say it, because we need all of them. If we don't make the investments profitable, then it becomes harder to deal with the issues with our planet. If we don't take care of the planet, we can't take care of the people. If we don't take care of the people, we can't do the profits. So to me, they are also like intertwined, and they need to be intertwined, and they need to be understood that they are all interlinked.
Thank you so much, Anna. Unfortunately, because of time, I won't be able to make any justice to Emmy, our stellar guest speaker from the Ministry of Foreign Affairs of Finland. Emmy, my apologies for that. But to our audience, please go to the event page to read Emmy's very, very impressive CBM biography. Emmy Oikari is the Director of the Unit for Development Financing and Private Sector Cooperation at the Ministry of Foreign Affairs of Finland. Emmy has an extremely impressive diplomatic career and representing her government in different countries. She also has a very diverse professional experience and knowledge, ranging from her experience working for Nokia, so a lot of knowledge about technologies, but also with multilateral development banks, because Emmy used to work also for the Inter-American Development Bank. Emmy, again, my apologies for not going deeper into your work experience and knowledge, but let me give you the floor so that you can deliver your closing remarks. Thank you, Emmy.
Thank you very much, and thank you for everybody for very, very interesting remarks. I will try to be also as brief. Of course, we very much need to now scale up sustainable finance in low and middle income countries. And Finland is a strong supporter of innovation, which is the key to development. And let me just start by thanking IFAD on the leadership role in promoting innovation, and also by commending IFAD for listing its first sustainable bonds at the London Stock Exchange last year. So I think it's fair to say that the answer to the question of the seminar is yes, profit and impact can go together. A few of the challenges, however, remain that we need to work on. Some of the challenges we had identified in the ESG bond industry really relate to differing regional standards, which make it challenging to access financing globally, as the requirements can differ significantly. The fact that the ESG bond market is heavily concentrated in developed countries, and for investors, the risk-return profile and lack of information are key barriers to invest in these bonds. And for issuers, the lack of sustainable project pipelines and the expertise to issue GSS bonds, leading to high issuance costs. And finally, the assets and liabilities can be difficult to match with each other. And Finland is committed to support innovation and ESG investment with our own instruments, and this was very inspiring discussion. Let's continue, because we really need to be innovative to finance the SDGs. Thank you.
Thank you so much, Emmy, and we really appreciate Finland's support to innovation, not only in the financial sense, but also through some of the financing mechanisms that IFAD is implementing in our development programs, but also through knowledge sharing and contributions to capacity building. So thank you so much, Emmy. Before we close today's event, I would like to thank our speakers, our partners, our audience here in the room, but also our audience online, and our team behind the screens. A special thanks to Julia Martorana, Chiara Marabotto, Adeshri Handi, Carmela Lopez, Manavi Pereira, and IFAD's IT and communications teams. Very special thanks to Sheila Kodamos-Platter for her technical leadership in the design of today's event. With this, I would like to close today's event, and thank you so much, everyone. Please join us at our next IFAD Innovation Talk. Thank you. Goodbye.